Greetings, this is Dr. Jeffrey Scott, and this is my weekend market update for 3/26/2023. I'm actually doing this on the 25th as I'll be traveling on Sunday. I entitled this A Tug of War Between Bulls and Bears, as we'll talk about what the market did. It was an interesting week, but a positive week nonetheless. Again, my name is Jeffrey Scott, and my email address is hgsidoc@gmail.com, and that is me in the lower left-hand corner addressing a medical congress in the fall of this past year. As always, this is for educational purposes only. Any recommendations are in the spirit of education and should not be considered investment advice. I am a doctor, not a broker. I am independent, which means no one pays me to say good or bad things about them, and I demonstrate the tools that I use in my daily trading. I have paid for those tools. Trading involves risk, and you alone are solely responsible for any investment decisions you make. The Wealth 365 is coming up again, and as you can see, it's the week starting April 17th through Saturday the 22nd. It's always a great event. I'll only be speaking once as there have been a lot of new speakers added. So I'm excited to be speaking on Saturday, April 22nd. It's usually at 10 or 11 a.m. I haven't seen the final time yet. So I hope you can join me, and I'll put the link to register. Register either way just in case. And please use mine if you can. I don't get anything for it, but Rob Hoffman, the proprietor of Wealth 365, is so nice to let me participate. I don't even have a mailing list for any of the things that I do. So the only ones that will register for me are ones that by word of mouth. So I'd appreciate it. For those who like these videos, I also do a week during the week video when I have a chance. This past week I was traveling, and frankly I'll be traveling some this coming week, but I'll try and get a couple done. And they're at stocksanddocs.com. And if you fill out and register, I don't even get a mailing list for this. It's done by Rob Hoffman for me. You'll get notified when I post new ones. So the markets last week were interesting. They were all over the place, but as you could see, almost everything over the 5-day period was green. Natural gas continues to lead to the downside, although it bounced a lot on Friday. ARC, small cap growth, was actually down. Part of the problem, I think, is the breadth of the market, plus I think they took a hit when Box, or Block, not Box, when Block had a big downgrade or a bearish commentary from Hindenburg. When we look in yellow at the major indices, you could see, pretty well balanced. Dow up 1.2, NYC 1.1, Spiders 1.5, the Nasdaq 1.8, Russell laggard 0.3, and the Nasdaq Composite 1.7. Now, what's also interesting is when you look at the moves off the lows, the Qs are in a new bull market, technically of being a 20%. But before I get too excited, it's important to recognize that we've seen bear market rallies in the 2002, 2008 era of much greater than 20%. So to me, we are still, until proven otherwise, in a bear market rally. You could see most of the sectors over 5 days were up. Real estate and utilities were the laggards. When I look at the Q Edge tool to get a sense of what's working, what's not, it's remarkable here to see 9 out of 11 sectors were up. And this is sectors using the S&P 1500, so they're broader based. And you could see the laggards were IT on Friday. This would be the one-day response, and communications. So it was interesting that those sectors that had been leading for some time took a pause on Friday, which you may have seen your portfolio not perform as well as you thought it did, looking at the major market indices, especially if you had jumped on a lot of semiconductors and some of the other leading technology names. What else do we see here? We see a difference. Last week we were mostly red on the sectors, industries, and stocks, and you could see on Friday the majority of all three were green or positive. We no longer have a lot of stocks near the bottom of their Bollinger Bands. And when you look at the week, 73% of sectors were up, 62% of industries, and 62% of stocks were up. So that's clearly a positive week. Now, when you look over 10 days, taking into account the prior week, which was very negative, it's leaning bearish. When you look over a month, it's still very bearish. So improvement. Now, my weekly market timing model, where I look for two things. I look for price to close above the weekly WMA and then to see a weekly bongo. You could see that, like last week, the only index that's holding in a bullish posture is the Qs, while the diamonds and Russell are both below the moving average with red bongos. And then the one in between, so I put caution, is the spiders, because the spiders closed above the moving average, but they haven't flipped their bongo. So still more negative than positive there. The Black Swan indicator by Dr. Eurodollar, which is puts out YouTube most days, shows improvement as the amount of red, whether I look at daily, weekly, or monthly, is getting lower, but it's still red, and red is when you exit. So it's not giving a signal to go in. And as I mentioned last time, I think it's interesting, and there's probably concern. There's a lot of different factors, including inflation and the economy, in this indicator. It fired during the 2000 period. It fired during the significant recession and bear in 2008. And I wonder if it tells me anything about recession coming or not. But it fires in bad bears, and it's still firing a warning signal. Now the rates came down. That's probably telling us something. The Fed has sort of telegraphed one more hike. And when you look at their expectations for terminal rates and what people think are terminal rates, they look to be coming down. If you look on the left, the 10-year dropped on the week. The 30-year actually was stable, which is interesting. Do we have a recession in our near future? I continue to be in the camp saying yes. Why? Upper left-hand corner, the 10-3 yield curve. Every time we broke below zero, followed by a gray band. The gray band is recession. We are well below zero. 10-2 yield curve. Pretty similar findings. The interesting thing is it doesn't look like we dropped much below it in 2020. And notice that the 2-year came up. And I talked about it before. Why would recessions follow the inversions? So while the 10 is tightening, the short-term maturities, the 2 years and 3 years, will go up even faster than the longer-term maturities. And as people start looking out over time and recognize that the Fed will come to a end of a tightening cycle, some of those longer maturities will actually be discounted versus the short term. When this happens and you're looking at potential recession, the short term, 2 and 3 years, will be greater than the 10 years. And that's when you get the inversion. If you think about when you buy your house, under normal circumstances, the shorter the time, the lower the interest rate. So this inversion changes that. So as the economy gets worse, as the Fed tightening has slowed things down, then what do you expect to happen? You expect them to lower rates. When you lower rates, the rates that are going to be impacted first are the 2 and 3 year rates. So those rates come down, and when they come down, they undo the yield curve inversion. So what is the driver of undoing the yield curve inversion? A slowing economy. What's a big slow economy? It's a recession. So I think that it makes sense why the yield curve inversion doesn't really occur until the economy slows and the Fed stops cutting. Credit risk. I look at the high yield index option adjusted spread, and I'm just pointing out that it's moved up some. And I think that's something to watch, because tightening credit could be the end of the tightening phase, as that could force the Fed. Now, we're not there yet, but I'm watching it. And then from an economic activity, we're looking at the diffusion index for the Philadelphia Reserve District 3. Notice whenever the blue line drops below the red line, it's followed by a gray bar. You can get down to that red line or just above it without triggering a recession. Notice where we are today, we are below the red line. Not a lot below the red line, but enough to wonder, is it baked in that we have a recession coming? Not saying that I have a silver ball and I know for sure, but that would want me to keep cash on the side, shift a little bit more to bonds as I've done in my long-term retirement portfolio, and be careful chasing these rallies. Breadth improves some. Hard to see it on the stocks above the 200, but you can see a little turn up on stocks above the 40. And then the very fast acting T2121, the 13-week new high, new lows, clearly turned up. That's, I think, bullish. Now we continue to have narrow leadership. Over here, we're looking at the spider, the RSP versus the spider. The RSP being the equal weighted S&P versus the S&P 500 SPY, which is cap weighted. And clearly, when you see this pattern, it tells you that there's a number of large cap SPY stocks that are leading the market, and that the average S&P stock is underperforming. If we look up here, you can look at QQE versus the Qs. If it's pointing up here, then the general market is doing better. When it's coming down, it tells you the large cap tech is what's leading. Over here, we're looking at, actually, you know what? It'd be easier, I think, for all of us to see it within the program. So we just bounce into the program real quick. Up, 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 up. Down here, we've got, let's just look over here, XSD versus SMH. So we knew semis were doing well. XSD is a broad-based semiconductor. SMH is narrower. And notice that the larger cap SMH is pulling this, showing that outperformance on the large caps. IBD 50, small cap growth versus FANGs, large cap growth. It's all about the FANGs here. And then Qs versus the Russell, you could see marked outperformance by the Qs. So those are things that I like to follow, and I think give us some insight into what the market is doing. Narrow leadership is not optimal. My buckets are more neutral. You still got 76% of the stocks below the median of their Bollinger Band. That would lean to bearish. We've come off the student body to the left, meaning student body to the lower part of the bands. Still don't have much in the upper bands. So I gave it a neutral because it's better. It's neutral to slightly bearish. Now, if you look at the NASDAQ and the NYSE and you look for Hindenburg omens, you're not going to see them. But what you see is you still got a lot of new lows, certainly on the NASDAQ, a little bit less on the NYSE. And I won't believe we're out of trouble until I see those new lows replaced by new highs. How do I balance the idea that we have higher highs on some of the indexes, especially the Qs? Not higher highs, but we're going up with the fact that the NASDAQ has a lot of new lows. The narrow leadership. Now, if I look at two different charts looking at the performance last week, and we're using the fundamentals at the end of the week on the week ending the 17th. So the first thing we're looking at here is ERG, which is a combination of EPS rank, relative strength rank, and group rank, and looking at as ERG goes up, what was performance. Now it looks like high ERGs did awesome, and they did, but the reality is when you look at the number of stocks in the head and the tail, they're meaningless. So what you see is a relatively flat week, slightly to the upside, and you look at EPS rank, it really didn't mean anything. Relative strength rank, yeah, high relative strength was good, but so was no relative strength. This was just a week where, to me, I don't see a pattern. and but I do see that it's above zero. Now, this is performance of a lot of different groups. What I thought was interesting is that up at the top I have the stocks that were pullbacks, and on the bottom I have breakouts, whether they're Bible gap ups, trilogy buys, my filter buys. So even though the vast majority of groups were positive on the week, breakouts did not work. My buy watch and the IBD weekend review were both up about 1.1%. The S&P 500 was up 1.48. The IBD 50 was up a half a percent. So this was not a standout week for growth, and it was a week that I think pullbacks were the ones to be playing. Know your news and earnings. Notice all these horizontal arrows on the left. Every day next week, Monday, Tuesday, Wednesday, Thursday, or Friday, there is a different Fed head speaking. And as I will comment on later on, if Powell has been perceived as bullish, the pattern has been for the talking Fed heads to talk down the market. So I'm going to be paying a lot of attention to see if they're piling on to the bullish perspective, or are they going to talk back any of the bullish perceptions that we got from Powell. Over here are the earnings whispers, earnings times. And as I say in the lower right hand corner, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. I think one that'll be interesting will be Restoration Hardware, a past major leader that has stumbled, and one that's tied to supply chain, housing, and frankly the economy, because it's a lot cheaper to buy furniture elsewhere. And I can attest to that, as I just have furnished my second home. Now, old slides, but I think there's something important. There's 2 points to make. The left-hand slide shows you the Fed rates in the dark color. The light blue is the market bottoms. Market bottoms don't occur without a Fed cut. So yes, we could be different this time, and maybe 50 years worth of data isn't enough. But typically, the markets don't stop going down until the Fed cuts rates. And on the right shows you the average bear market, whether it occurs in a strong economy or in a recession. And if we go into recession, we could see substantial falls compared to where we are today. So week started, ended on a pretty firm note. In between, lots of volatility, Fed, investors weighing ongoing concerns about bank industry along with latest policy moves from the Fed. The good news is it looks like right now it's about 5 o'clock on Saturday. No banks have blown up since Friday. Bank stocks did whipsaw as Yellen's message confused and was changed. Strong week for stocks, probably favoring growth. Some of the recent leaders seem to soften on profit taking Friday. We are entering or are in a strong seasonality period of the market. This could give us a short-term tailwind, lead to higher prices as participants debate whether the Fed has signaled an end to rate increases. This week we have multiple potential catalysts, so you have to pay attention. This includes everything from jobs, sentiment, the ever important PCE on Friday. A weak economy paradoxically should drive the rally. However, as I mentioned before, lots of Fed heads. I still am concerned about a recession. I recognize markets don't bottom while the Fed is still raising, and we are still seeing raises. So I will be cautious and not overcommit. That does not mean I'm out of the markets. It means smaller positions, tight stops, no more than a 1-to-1 or 2-to-1 risk ratio. Take profits early and move my stops to break even. Still have cash available. I am not in margin. And if one looks at many of past major bottoms, there will be plenty of time to make money once we have a confirmed rally. I will be watching my market timing model, also paying attention to things like follow-through days and other signs of a significant change in the market. Lastly, just to remind you, wealth365.com/Dr.Jeffrey-Scott. Love to see you at the Wealth 365 event, and I would love it one way or the other that you use my link to sign up. So on that note, it's time to go on to the charts. As usual, I've got 20 minutes on my thoughts about the market, and although I know people like me to be in the program and looking at charts, I am a top-down guy, and the first thing is the market. And let's go take a look at some indexes and see what we're thinking about that market and where we might play. So the first thing is the hot sectors would be sectors that had a big move on some of the Hoffman algorithmic technical indicators. Now, SPTM is the S&P 1500. Now, 146 is not a great number. It's sort of a sideways number. You can see the chart hasn't done anything. But the fact that it had a flame makes me get interested. Same with the spiders, staples, we saw a number of those. But notice these numbers are quite low. On the indexes, I thought this would be a good way to start. This is a 5-minute on the spider. Started the week on Monday, ended up closing higher. Big gap at the open Tuesday and ran up in the final hour to get close to back and to take out the gap high. So Monday and Tuesday were awesome. Wednesday really didn't do nothing, and then the Fed statement came out, and as you could see, all over the place, and the more Powell spoke, the more the market fell. Thursday we gapped up at the open, and then we sold off the rest of the session. I think it was the Deutsche Bank popped up. And then Friday, we actually bottomed early and traded higher into the close. When you look at where we started the week compared to where we finished, it was a positive week, but you could see we were all over the place. If we look at the daily S&Ps, we are still in this area where we're above the 200, hip hip hooray, the daily bongo's gone green, the MACD has turned more bullish. We're still below this trend line and above this trend line. So I would say we're still in territory where caution is advised. Now another way to draw trend lines could actually have you do this. And I think we need to be aware of this. Let's draw this one. I mean, we are in a bit of a wedge, or a triangle, probably is a better way of calling it. And one would expect that we're going to resolve out of this soon. The question is, does the NASDAQ pull this higher and do we go back and retest the February highs? Or do we break down and retest the October lows? And I think this is something important. I don't have that answer. The market will tell us over time. But I expect we're going to see something soon. If I want to take just at face value, we had a strong day on Friday. On the week, we closed up, as we know. And I think that's all I can say. The NASDAQ is trading above their descending trend line. The NASDAQ had a stronger week. It's above the 50 and the 200. The Dow cannot get back above this line here, which was support, turned to resistance. And the Russell's probably the weakest of them all. And as you can see, the Russell's bouncing around this white line, which takes us back to the December low. I think that the concerns in the market early in the day on Friday caused a gap up on the VIX, but on the day, the UVXY actually closed down 5.75%. The volatility coming out of the market is good news for the bulls. And then the dollar is still below my line in the sand. As long as it stays below that white line, I think that that would support some strength in the market. If we look at commodities, let me just connect to my Tastyworks. Now, if you have my scanner, and my indicators, there is not an issue with the Tasty login, but the issue is that there's not enough data loaded from Tasty to trigger all my indicators. So I don't use the Tasty for my charts except for symbols like the 10-year interest rate, which are not in wealth charts. Indecision day right on the 50, on the weekly, on the TNX. And if we look at the daily chart, we can see, whoops, wrong one. Let's change that again. We can see that closed on the lows of the session. So that is not strength. That's a breakdown of the 10-year. And unless it's rolling over because we're going into recession, it's probably good news for stock investors. So the dollar's been soft. You can see what gold has done. The interesting thing with gold is it's basically at all-time highs. Now it had a sort of a tough session on Friday, certainly at a place you would not be surprised to see a pause to refresh, but we'll see what the general market's doing. Is it a flight to safety? Is it a weak dollar? Same thing with silver. Silver traded up and then ended up down on the day. Um, Oil really hasn't done anything. Natural gas, as I like to joke, is dead to me. And why would I say that? Because it's dead to everybody. It's acting like there's no war in Ukraine. I've already showed you the weekly market timing signals. I leave these arrows and this caution sign up because to remind me that the weekly bars are not done until the end of the day on Friday, and the signals will be in place until Friday. So people might go, Jeff, does this mean you don't take trades? No, that doesn't mean I don't take trades. It means that I favor technology in the Qs. I think the spiders are interesting here, and spider components. I am concerned about Russell and Diamond stocks. That's what's out of favor right now. Would I still buy one if it looked good? Sure, I would. But keeping with my theme, I probably wouldn't take big positions, and I'm going to have tight stops. We looked at breadth already. S&P 500 hourly. Just letting everything build up. So my money bags have been for weeks now sitting on technology as my favorite. I don't think anything's changed here. Technology still looks good. That's been a good place to have your money. Start on the left. Materials, no. Communications, kind of like technology, super strong. Just take a look at Meta stock. I mean, wow. Kind of like when it first came out. In fact, it's a star, so it's going to give I'm going to give it a star. Energy weak, financials weak, industrials weak. Talk about market narrowing. The only things pointing to the upper right are communications and technology. Now, staples, utilities, and healthcare are moving up off their lows. And I will tell you that some of the more attractive stocks that I saw, but when I looked at my 1,000 stocks since the market closed on Friday, quite a few staples, Kimberly-Clark, Coca-Cola, things that are not growth stocks in the classic sense today, actually look to be at decent positions. And surprisingly, discretionary is holding up. But you could see two things that are not like the others, and those are technology and communications. Now, if I look at the heat map on Friday, you'll notice that there was some profit taking in some of the recent leaders. Nvidia, which is just such a monster stock right now. Look at this run. My goodness. Tesla, which has had a move. Google, Amazon, AMD. AMD, a great run after from the time we talked about it from 86. It's still up over $10. But you could see what technology recent leadership did take it on the chin on Friday. Wealth scanner, TLT. I mean, I mentioned earlier and that I moved more and more of my portfolio to bonds, and I did that because I'm in the recession camp. And you can see TLT here is actually doing well. What would drive TLT higher? Well, TLT would be driven higher by falling rates or slowing of the rates, or flight to defense. Triple Qs is the next leader, 820. You could be playing that as an ETF. And if you are, you probably are positive unless you bought it in the last couple of days. XOK Technology, 755. Look how beautiful that chart is. And then a way of playing all this is the Qs, which looks just like technology. That is clearly where the leadership of the market is. The FANG stocks have been doing well. You can see here. But you can also see on the weekly chart, they've sold off quite a bit. So now you get to the point where we've learned a few things about the market. We've learned that it's narrow leadership, it's technology and communication driven. Now, what do I look at to find if there's anything attractive that I might want to put on a watch list and consider taking a trade on? So that's where my CAT scanner comes in. I have been using these techniques that I will show you over the next few moments for trading for 25 years. There are other programs that I've used in the past, and I still use other programs. HGSI is a great program and one that I still enjoy using. The reason why I'm doing it within wealth charts is it's so easy. So my CAT scanner allows me to customize what I'm looking at. And I like looking at price over 500,000 shares, at least one bullish dot. And I don't want to find things that have run so far I can't buy them or I can't find a decent buy spot or a stop position. So I'm going to look for a no bearish dots and a reversal in the daily bongo within the last 2 weeks. Now, since I'm requiring a bullish daily and weekly bongo, that means the reversal on the short term went from a short-term downtrend to an uptrend. That's my favorite pattern. So I could look at anything. So let's just look at technology. And actually we'll look at let's look at technology. We'll give it a couple seconds to run. This one takes a while. All right. So within technology, these are the only stocks that had my pattern of a short-term reversal and a longer-term uptrend with bullish movement. Why do I want the bullish movement? Because things can go sideways for a long time. Now, Activision is not something that we're going to be playing with because, well, we have to go figure out what the takeover price for Microsoft. But when the British said that we don't have a problem with the Microsoft takeover, you could see a high value move. And now I would say the likelihood of this deal closing is much higher. So I would do a little research and figure out what the closing price is, that it's an arbitrage play. I don't know EVOP. EVO payments, $1 million shares traded. Let's look at the pattern. All right, this looks to me like a takeout. So I'm probably not going to play there. BSY, that's only one dot. Bentley Systems. Let's just see if any of these look good. Kind of choppy. Salesforce. All right, so Salesforce is moving, and it's moved a while already. Probably a better time to have gotten in would have been back here with the 3 dots, and then the following day it took off, but you don't get the chances to go back and coulda, woulda, shouldas. Salesforce looks interesting to me. I'd look for some more momentum to come in. FSLY is one that I've been watching, and this one has gap up, sideways consolidation. Looks like it might be ready to go higher. Microsoft actually is a leader again. And you can see Microsoft had a strong day on Friday and a week tape up over 1%. Now, do any of these knock my socks off? No. But Activision's probably worth figuring out the buy price. If we look at semi should be in here. let's look at communications and see if any of the communication stocks look particularly interesting here. Baidu, I think Baidu does look interesting here. It's not a clean cup and handle, but sort of a cup handle, and it looks like it's going to run. Look at relative strength and OBV. DoorDash, Liberty Media, lazy boy. So I think the star in communications to me is Baidu. Now, is this really, this can't be a legal zoom, not lazy boy. Okay. And then I might also want to look at a curated list of growth stocks, especially as I said growth is leading, and they're called my combo leaders list, a list that I share with you each week. And I could take that watch list. I don't know Atlas Corp at all. Kind of a sideways, so I'm going to ignore it. Renew Activision, Renew Energy. I didn't like this. Notice it's got 4 dots on massive volume and took out the 50. All of that is great. Problem is it's in a downtrend and it's got to get through the 200 and it's a cheap stock. I do like the next one, AUPH. Why do I like AUPH? It's a biotech that sold off hard. It's certainly outperforming the other biotechs because the biotech itself, let's just show you how you can prove that. Let's go duplicate chart, move it here, and let's add IBB. And let's hit this button, the 1-to-1, that'll create an ETF. And the point I want to make is, and let's make this a line, don't need candles on this. Parameter, I don't want that. Hold on a second. Let's go to okay. So what you can clearly see is AUPH is way outperforming biotech. Why do I like it here? Let's get to I want to make that one AUPH, not. Let me bring it up. I like this pattern. It broke above the moving averages, retested them. Notice a quick reversal to the downside on the bongo, now turned green. 3 dots coming out of a squeeze, a spike in relative strength at OBV. I think of all the stocks we've looked at so far today, that one I like the best. ELF, oh my God, what a leader. Now, is it too far gone? Look at how this stock is different than all others. Yes, there were buying opportunities back here. There were buying opportunities back here at the volume and all the green dots. It looks like it's giving another buying opportunity. This one is a little bit more extended now and higher risk, but you got to love ELF. There's Evo Payments. Looks like a takeout. Intuitive Surgical is a robotics company. Now, it's way down in the pattern, got lots of overhead supply, but I can't ignore the fact that it's taken out the 50 on massive volume, 3 green dots, and relative strength and OBV have turned up, and the high jump of 54.51 says it's not extended. Here's another medical stock, doesn't look that impressive to me. Aon, this is a very old name. Now it's got to get through the 50, it's an expensive stock, but that's what I might look to see, and a break above the 50 could be interesting. Now I mentioned some of the staples we're plucking up. So let's just put up consumer staples. And let's see which ones. All right, ELF was one. Church and Dwight, they make a lot of things that you buy. You may not have heard of them. A lot of things you might buy over the counter at the drugstore. 2 dots, took up over the 50. Not much relative strength in OBV. I'll probably be watching it. Clorox, what's new in Clorox? But you got a nice base here. And again, relative strength OBV not doing it for me. Costco. Costco is interesting. Look at the volume. Look at relative strength. Breakout and momentum on good volume, not great volume. Similar to Church and Dwight, I'd be putting this on a watch list to see what happens. Costco, we looked at that. Hershey. I guess something's new in chocolate bars. Maybe they got a new flavor. But Hershey looks great here. Big volume, breakout momentum, relative strength in OBV. So what I just did, if you think about it, we've been on this call for 40 minutes. I spent 20 minutes showing you how I've looked at multiple different tools to come to the conclusion that this market, in my opinion, is probably going to grind higher. I am the seasonality being very supportive, but my main concern is what comes next with the recession, and that's going to temper my enthusiasm. Of course, I'm going to play the market we have, not the one I think we should have. Second, we showed narrowing of strength in technology, communications, lead, and as I mentioned, I thought staples were starting to wiggle. Now, staples would be a sign that the market isn't going to go much higher. I then went into my CAT scanner, looked first at technology, then we looked at communications, and we finished by looking at consumer staples. In between, we also looked at our combo buys. The beauty of my scanner is it helps me find what's moving now. I hope you have an awesome week. I will be in Nashville at a conference called VIVE, which is a healthcare technology conference. I will hope to get the videos out, especially because I think this week could be volatile. And remember, a talking Fed is an opportunity for volatility. We have one every day. Have a great week.